Hi viewers, welcome you once again to Micro Learning. This is again Shailaja along with you. So we have started with the 6th chapter. It's banking, a very interesting topic. You have already learned this part in commerce, but let us touch once again the part of commercial bank. So today we are going to continue with lesson number 6, banking. So today we are going to see 6.3.2 to 6.3.3. So let's just give a recap. Okay, what is commercial bank? It's a bank which deals with deposits and loans. It gives for individual as well as for business people also they give. Okay, they not only do that, they support the primary and the secondary sector also. And the bank is also having two important functions, the primary function and secondary functions. And money supply is being circulated in the economy. All this we saw in the previous class. So today we are going to see mechanization or the technique of credit creation by commercial bank. How does the commercial bank create credit? Okay. So bank credit refers to bank loans and advances. Suppose you go to the bank and you are in need of loan. You know what are the formalities that you have to do when you want to avail for loan. After you completing all the procedures, the next one is the bank does not make any cash transaction across the table or across the counter. What does it do? It opens an account in the name of the person and the money is being credited into that account. That's the best procedure that a bank follows. Okay, and they are not supposed to give it across the counter. So what happens? A person, for example, myself, I'm going to the bank, I'm in need of loan. Immediately the commercial bank goes through all my documents, verifies and see what's the eligibility for the loan, and if I am eligible, they pay me the loan. But only on one condition. The money will not be given across the counter. It opens an account in my name and the money is credited into my account. Okay, this we call it as credit creation by the commercial bank. So the money is said to be destroyed when the loans are repaid by the borrowers to the banker. So suppose I have borrowed and when I repay the bank loan, that bank loan is supposed to be closed. So we have cleared all the credit procedures in the bank. The next one is, suppose banks have the power to expand or contract demand deposit. Okay, this will be done with the help of the RBI's instruction. They exercise this power through granting more or less loans and advances and acquiring other types of assets. It's not only loans and advances, even in other types of assets also, the commercial bank can create money. This power of commercial bank to create deposit through expanding their loans and advances is known as credit creation. So if anyone asks you what is credit creation, the credit creation is nothing but creating a deposit through expanding their loans and advances. This we call it as credit creation. Now the primary or the passive deposit and derived active deposits. So the modern bank creates deposits in two ways. One is primary deposit and the other is supposed to be a derived deposit. So we should know what is a primary deposit and we should know what is a derived deposit. So what is a primary deposit? A primary deposit is nothing but a bank creates a book of debt in its name and it is called a deposit. This is known as primary deposit. So I told you, as usual, you open an account and into that your money is being credited. Next one is derived deposit. What is derived deposit? Derived deposit is nothing but the prior payment in the form of cash to the bank. This is called as derived deposit. Now what is credit creation and what do you mean by it? Credit creation is nothing but multiplication of loans and advances. So you have a question here. What is credit creation? It's nothing but multiplication of loans and advances. So every loan creates its own deposit. So what does the central bank does? The central bank insists the commercial banks to maintain a ratio between the total deposit they create and the cash in their possession. So always the RBI instructs the commercial bank what to do, to keep an amount of deposit in their account, and the other part it goes as CRR towards the RBI. So further, the purpose of understanding, it is assumed that all banks are obliged to keep a ratio of cash deposit at a minimum of 20%. So every bank is supposed to hold an amount of money in their bank. Did you understand? The banks do not keep any excess reserve. Okay, and always know that money should not get stagnated anywhere. Money should be flowing from hand to hand. That is, if the public is having more money, the commercial bank will take away from the public towards the commercial bank. When the commercial bank is having more money, what does the central bank does? The central bank takes away from the commercial bank. For each taking over, there is a procedure of taking it. For example, if the public is having money, how does the commercial bank withdraw the money from the public towards the bank? It gives more interest rate. The interest rate is higher and attracts the customers. So when the customers are getting attracted towards the interest rate, normally the money flows from the customers towards the bank. Same way, now the commercial bank is having more money. Now what does the RBI does? The RBI increases the CRR rate. When the CRR rate is increased, what happens? The money flows from the commercial bank to the RBI. So this is how the money keeps on rotating. So the bank do not keep any excess reserve. It would exhaust possible avenue of income earning activity by giving loans, etc. Okay, excess money is given to the public in the form of loan. So there is no drain in the supply of money. That is, the public do not suddenly want to hold more ideal currency, or they neither withdraw from the time deposit. People generally like to reserve their money and keep it. Immediately they will not send it as such. So a customer deposits a sum of 1,000 in a bank. So what is happening? The bank creates a deposit of 1,000 in his name, and the bank deposits have increased now. Okay, how much the bank deposit have increased? The bank deposit has increased 1,000. So because the customer has deposited 1,000 rupees, so the bank deposit has increased to 10,000. But at this stage, there is no increase in the total supply of money with the public. So the above extra bank money 1,000 is offset by the cash of 1,000 deposit in the bank as such. So the bank has now additional cash of 1,000 in his custody. So what happens? Since it is required to keep only a cash reserve of 20%, out of 1,000 rupees, 20% has to be kept as reserve. So the extra 800 rupees, it goes out as cash reserve towards the central bank. Now, what is primary deposit? Okay, or you can see here passive deposit. Now what is primary deposit? It is out of these primary deposit the bank make loans and advances to the customers. Of course, whatever the customers deposit into the bank, that is being taken and it is resent towards the public in the form of loan. So the initiative is taken by the customer themselves. In this case, the role of the bank is supposed to be very passive as such. So we call it as passive deposit. So primary deposit is also called as passive deposit. Now what is the role of a commercial bank? Commercial bank has certain roles, like it is giving capital formation. Next is it is creating credit. Third one, it is challenging the funds. And fourth one, it is encouraging the right type of industries. Then bank monetize debt. Then finance to the government, employment generation, and bank promotes entrepreneurship. So what is the role of the commercial bank? So go through the slides once again and try to jot down the points for your reference as such. So those who are watching the channel for the first time, please like, subscribe and support micro learning. Thank you very much.